A little over a year ago on November 4th, I made a video called Never Trade the VIX, and I talked about how I was going to trade the VIX using VXX. The reason why I'm playing with the VIX at all is that I'm doing it in my speculation and play account. I'm using a very small allocation, and I think we might see a catalyst between now and the end of the year that could cause a spike in the volatility index. So what happened? I made a comment about when I was going to get out of the trade if we didn't see a volatility spike. Obviously, I didn't do that. And instead, since this is in my speculative portfolio, I decided to conduct an experiment where I would see if I could keep adding to the position over time until we saw a volatility spike. It's important to remember that you shouldn't trade the VIX. There's a lot of problems with it. First off, the Volatility Index, or VIX, also known as the Fear Index, measures the volatility that takes place in the stock market using the next 30 days of options plays. Since the majority of options volume is usually placed on puts, people are more concerned about protecting against the downside than they are about taking advantage of the upside. The VIX typically only moves when we see downward spikes. So trying to play the VIX just by itself is a very challenging thing because who knows when there's going to be a downward spike. To make matters worse, because there are fees and costs to creating an instrument that trades the VIX isn't something you can invest in. It's just an index measurement. There's something in all the investing instruments called contango, which means that the underlying asset will be costing less in out months than it is in near months. And this is not good either. Both of these combined means that over time, if you hold on to one of these assets, it will degrade in value. And that happens even if the VIX stayed stable or goes up a little. So you're playing against time. This is why I initially said that I was going to only hold VXX until January, and if we didn't see a spike, then I was going to sell it. And being the crazy person I am, I held it beyond that. Once again, this is my speculative portfolio. I was fully prepared to lose all the money that I was putting into VXX in the event that it went to zero or that it just degraded or I had to close the position. This portfolio is where I experiment with crazy stuff like this. This is not something I would expose a lot of money to, and I didn't think I was going to make any money. So let's look at exactly what happened when I was holding the VIX and how exactly I approached the entire trade. So this is what my trade looked like on the charts, and we're not going to go over every one of these buys. Simply said, each one of the black arrows indicates where I added to the position. So what I was doing was adding in very small quantities as VXX reached new all-time low after new all-time low. And as you can see, I got a little carried away. I started by opening the position on November 2nd at $87 and then just added every single time the VIX would go to new all-time lows. And when it was trading down there, I thought surely we would see a spike eventually. You can see that all the way through December of 2023, VXX went from where I opened it at $87 all the way down to my final ad of 2023 at $63.40. But I wasn't done there. Throughout 2024, I added at different periods as the VXX continued to make new low after new low, finally culminating here in June of 2024, where I made my last buy at $44.20. And this left me with a cost basis of $65.80. In other words, even after adding in stages all the way down, my position in VXX was nearly down 33%. This means that the underlying position was worth a third less than the money that I had put into it. And it was at this point that I decided I was going to go hands off. I put on a deadline. I said, okay, if this doesn't make a spike between now, June 7th, and the presidential election, then I'm going to close the position at a loss. And I'm not putting any more money into this. I was at my max. If you were paying attention to the markets, at the beginning of August, we had what was called the reverse of the yen carry trade. The Bank of Japan raised their interest rates for the first time in decades. And as a result, a lot of traders who were borrowing yen and then using that borrow to buy other assets had to cover. And this created a huge spike in the VIX, as well as a pretty epic one-day sell-off. The NASDAQ at its low sold off around 7%, and the S&P 500 sold down significantly as well. This was the spike. But although it reached its peak on August 5th, I actually started selling into it on Friday the 2nd. I made my first sale on the 2nd at $63.31, and I sold 22.95% of the position. Now, this might seem weird because this was actually below my cost basis. At the time, my cost basis was $65.80. However, spikes in the VIX are very infrequent, and I had no way of knowing that the spike that was happening on Friday the 2nd was going to continue over the weekend. So I decided it was time to take some of my risk off the table. This sale ended up raising my cost basis 7.13%. up to $70.85. And that's when we went into the weekend and Monday hit. I happened to be at my computer before the market opened and noticed the VIX was spiking to levels that we hadn't ever seen in extended hours trading. When you're trading an incredibly volatile asset, it's actually a big benefit to take advantage of extended hours trading because the liquidity is lower then, which means the underlying asset, in this case VXX, would move a lot more than it would in regular trading hours. I noticed that it was trading over $90 a share, so I didn't waste any time, and I made my second sale where I sold 33.8% at $93.25 in extended hours trading. This sale lowered my per share cost 15.81%, down from where it was at $70.85 on Friday to $59.65. The key to trading any volatile asset isn't to assume that the spike is going to continue. So I wasted no time and made my second sale also in extended hours trading at $90 even, where I sold 32.63% of the position. This sale lowered my cost basis 50.86%. down from $59.65 to $29.31. And it was at this point where I decided to keep the rest of the position, which was now relatively small, just to see what was going to happen during regular hours trading. And that's when VXX really came back under control. I gave it a little bit more time before closing the position entirely. And I sold the remainder, the 28.75% that I've been holding, at $79.30 during regular hours trading. At the end of all of it, I ended up making a profit on the position of 18.13%. So overall, this sounds like it really worked out, right? I will likely never trade VIX again. This was a very interesting experiment, but also proved all the adages were correct. Even using my techniques of buying in stages did not save me. I got incredibly lucky. The VIX hit a record high practically on that day. I thought that you could hold VXX, and as long as you kept adding to it, eventually there would be a spike. And while that ended up being true, if I had held on to it much longer, even this spike might not have saved me. To learn more, visit getirk.substack.com.